Most financial advisors are using the same strategies for someone with $5 million as they are with someone with $500,000, and that's a huge problem. And I know this because I talk to families with $5, $10, or even $20 million that are paying their advisor a 1% fee to be put in the same mutual funds and basic tax strategies of someone that's making $100,000 a year. And if that's what you want, then that's totally fine, but it doesn't have to be that way. My name is Samuel Harnisch, and I'm the founder of QFS. I spent years working at a $1 billion multifamily office before starting my own firm. The difference in sophistication between what ultra high net worth families receive and what typical wealth management firms offer is staggering. And most people don't even realize that they're getting shortchanged. Today, I'm gonna walk you through exactly why the traditional advisory model breaks down once you have significant wealth and what you should actually expect from wealth management at your level. Because if you have 5 million or more and your advisor's biggest value add is rebalancing or tax loss harvesting, then that means you're potentially missing out on much greater value add opportunities. So the problems that you face with higher net worth levels are completely different. You're dealing with something like executive compensation packages, you own a closely held business, you require complex estate and legacy planning, and need strong family governance. When it comes to tax planning, the generic advice is max out your retirement accounts, maybe do a backdoor Roth, and do some tax loss harvesting. The sophisticated advice is add something like a cash balance plan so you can add a few $100,000 to your retirement accounts per year, or use private placement life insurance so that you can grow the investments in there tax-free, and pair your Roth deductions with ordinary income deductions so that the conversions are completely tax-free. When it comes to investments, the simple advice is diversify across public stocks and bonds, and maybe add some muni bonds if you're in a high tax bracket. The sophisticated investment approach has far more diversification across private real estate, infrastructure, and hedge funds, and it's all being implemented through a tax-aware mindset. Simple liquidity management might look like a HELOC or an expensive margin loan. Our approach includes the cheapest form of securities-based lending through box spreads. When it comes to estate planning, and this is probably the biggest one, if your net worth is below the estate exemption, it's not really an issue, at least at the federal level. When you have a high net worth, you need to work with someone who understands how to use GRATs, ILETs, and all the other strategies to get assets out of your estate. All right, so let's dive deeper into portfolio construction. And the way I see it, there's really two big differences, and one is just simply access, and the second is the need for liquidity. Once you reach a $5 million net worth, you are considered a QP, and some of the best investment products out there are only available to people who meet that QP accreditation standard. And some of the highest octane, highest expected return investments aren't fully liquid. And when you have portfolios that are $5, $10, $20 million, you can actually afford to put some portion of it into investments that aren't daily liquid. And they come in all kinds of shapes and sizes. Some have monthly liquidity, some quarterly, and some are true long-term lockups where you commit your capital for 10 plus years. And which one is the right fit for you depends on your risk tolerance, what your goals are. Is this multi-generational wealth? Because some people, they'll set aside some money and say, this is going to my kids or my grandkids. Well, in that case, giving up liquidity for higher expected returns can make a lot of sense if we know it's going to be invested for 30 or 40 years. And the reason why I like to add asset classes like infrastructure, real estate, or hedge funds to portfolios is less about the enhanced return potential and much more about the diversification and risk reduction. When we look at the US stock market, for example, today, valuations are extremely high. And what that means is expected returns for the future are much lower than what we have experienced over the past 5 to 10 years. And whether that happens or not, no one actually knows, but what you want to do is you want to increase the probability that you hit your minimum return target. And one way to do that effectively is instead of just relying on the stock market, you can harvest risk premia, that's like the fancy way of saying it, expose your capital or your investments to different kinds of risk drivers, where if maybe one is doing extremely well, one is a little more muted in that period. If one is in a drawdown, this other one is up a lot, and you can rebalance and create a much more robust, higher risk adjusted return overall portfolio. A lot of people think that alternatives are something that's being force fed to them because they have higher fees, and so it's just Wall Street is trying to push them on you. There are some products that I I wouldn't use that aren't great. That being said, just investing in stocks is a suboptimal decision or a suboptimal portfolio for anyone that is at or nearing retirement, simply because we can't control the returns that the stock market give us. The longest stretch of negative real performance of the stock market was 16 years. So that means if you hit 65 and you retire and your entire portfolio is stocks, it's entirely possible that you go for a 15-year stretch where you don't actually make any money in your portfolio while you're withdrawing from it, and that is a huge problem. So that's how I view alternatives. I put them in the portfolio to increase the probability that we're hitting the returns we need so that people can enjoy their retirements. Next, I'm going to jump into the ridiculous tax-aware investment strategies we do, but first I want to be clear about something. There are some excellent advisors out there who do provide sophisticated wealth management. They're just rare and their minimums are often very high. At QFS, we built our entire practice around bringing these sophisticated strategies to families with $5 million or more in investable assets. We provide the same caliber of investment and tax planning that's typically reserved for families with 50 million or more in assets. And we're able to do that because I've had the chance to work at some of the top firms and built relationships with the best investment managers in the world. We can't work with everyone, but if you're frustrated by paying fees to an advisor who's doing things that you really think you could just do on your own, then feel free to reach out. The link's in the description if you want to see what sophisticated wealth management would look like for your situation. But now let me show you the best tax-aware investment strategies that some wealthy families are missing out on. So the way we invest in taxable brokerage accounts is we don't just get the investment returns, we also get deductions along the way that can be used to reduce your taxes. So instead of just investing in the stock market, what we do is something called tax-aware long-short equity investing. And what that does is we get the same exposure to the stock market plus an opportunity to outperform by going long some good stocks, short some bad stocks to create an additional return on top of the stock market. And along the way, we're able to harvest large amounts of capital losses. So imagine the stock market returns 10% in 1 year. We're expecting to beat the market over time, so we might have a 10.5% return for that year. But in addition to that, we can harvest up to 90% of the account's value in capital losses in the first year. And that's still while making money. These aren't true economic losses that you would see a 90% drop in your account's value. Your account would be up 10.5%, but you've also been able to pull out 90% of the account's value in capital losses. And this can be huge for anyone with exposure to capital gains. Whether that's you're selling a privately held business, you have a low basis concentrated stock position, or you work in private equity and you have exposure to capital gains and carry from the portfolio companies that you're investing in and managing. We're also able to invest in tax-aware hedge funds, which provide diversifying return streams that aren't correlated to your traditional public stocks and bonds, but along the way, they also pass ordinary deductions. And those average around 30% a year of whatever you invest in the form of an ordinary deduction. So if you were to invest $1 million, you would expect somewhere around $300,000 of an ordinary deduction, which you would be able to take against your W-2 income. And this also opens up the door to the super duper mega tax-free Roth conversion, which is where we use the deduction in your low income years or maybe early on in retirement. And we're going to convert all of your retirement account balances, your 401k, your IRA, we're going to get that over into a Roth IRA. And that conversion realizes or creates ordinary income, which we will then offset with the tax-aware hedge fund deductions. All right, so let me give you the insider scoop on what's going on in the wealth management industry. Firms want to systematize everything so they can drive down costs and increase profitability. This is increasingly becoming the case over the past few years as private equity has entered the space. You've got these massive firms that are called aggregators that go around buying as many wealth management firms as they can just so they can accumulate assets. And once your advisor sells to one of these aggregators or private equity firms, you're slowly going to get transitioned to their way of doing things. And the way that they make it scalable and profitable is everyone's portfolios start to get more and more and more similar. Say for your liquid exposure, everyone might be on the exact same investment model. So there's less customization and time spent getting to know your specific situation. If your advisor is using models and you're in the high net worth category, then you're being underserved. I've chosen to sacrifice profitability and scale for my own firm because there's too much value we can add by completely customizing each family family's portfolio. Once you have serious wealth, your needs become increasingly complex, and you need an advisor that has been trained and knows how to handle these problems that you have by using the most sophisticated investment and tax planning strategies out there. You shouldn't settle for a retail level service just because you don't have $50 million. You've worked hard to build your wealth, and you deserve strategies that actually match the sophistication level of where you're at. If you want to see just what that would look like for your situation, go ahead and use the link in the description and book a call. Make sure to subscribe for more videos on what wealthy families should actually expect from their advisors, and I'll see you in the next one.